Hi, friends. We were discussing on asset allocation, and since this topic came up, I thought I can quickly update on what I feel about it. So, I personally feel that we have got five major avenues of parking our money. The first one is real estate, second one is equities, third one is debt, bond, or FD as we call it. The fourth one is gold, and the fifth one is keeping our cash with us. The first one, real estate, I don't foresee that going anywhere in the next 3 to 5 years or even further. If you own a real estate which is for your self usage, I think that's more than enough. So, be it your house, your farmhouse, your shop, your office, your factory, anything more than that is not needed. It will not fetch you as much returns as we have got in the past. There are multiple reasons for this. One basic reason is oversupply. Um, the last asset class which I was saying was cash. So, cash sitting idle in your bank is also a wrong option because you will hardly fetch 3 to 4 to 5% of return, which doesn't even beat inflation. So, we are left only with the next three categories, which is equity, debt, and gold. My asset allocation in present scenario with COVID-19 and all the issues is that I am keeping a good portion of my asset in debt and especially liquid funds. So let us come to debt first, which is the one of the safer options. So what is the debt fund we are looking at? So we're not looking at long-term debt. We're looking at liquid funds, overnight funds, all AAA rated, definitely, and maybe short-term FDs. The liquid funds would have a more major holding because I am not 100% convinced about the market levels right now. So presently in my debt and liquid funds, I would have around 30% of my value. I'm still approximately 60% invested in the market. So it's 60% equities, 30% debt, which includes FD, long-term debt, short-term debt, liquid funds, a mix of all. And the last 10%, which I feel is very important now, and which allocation can be increased, is investing in gold. I believe gold is a hedge against the US dollar, and gold is also a hedge against any economic sort of war or an economic scenario that comes up between the powerful US and the rest of the world, or with China, and with all this COVID-19 issues happening, a lot of trade war will start, and gold is an excellent hedge. So from here on, I would slowly park another 5% from my debt, short-term debt, into gold. So what I'll do is I will be 60% equity, around 25% debt, and 15% gold. Let me give you this scenario. If your portfolio is of 1 crore, 60 lakh rupees in equities, 25 lakh rupees in your debt slash FDs, and 15 lakh rupees in gold, that would be a breakup and that would make 1 CR. Now, how and why you would do gold? Why? The reason is simple. Gold over a period of last 10 years has given you decent returns. In fact, gold in the last, let's say, since 2005 till 2020, the last 15 years, gold has gone up from 7,000 to 45, 6 times. More than 6 times gold has given return in the last 15 years. So that's a different type of a bull run. Gold should reasonably give you, let's say, if gold doubles and then doubles every 10 years, that's a decent return. So gold, I would rather keep 15% of my portfolio right now, and the sovereign government bond, gold bond, is the way to go because we are getting tax-free returns after 5 years of holding, and the 2.5%, which is taxable, but still it is not a bad bet, and we are also hedging ourselves. The 25%, which is to be in the debt part, could be a mix of FDs. Make sure FD is spread in at least 2 banks, and it has to be the top pedigree private sector bank or an SBI. Um, debt funds, you can also go for liquid funds or short term debt bonds, or you can also go for overnight debt funds. Triple A rated and double A plus, nothing lower than that. And finally, equities. So 60% in equities right now, be it directly through mutual funds or through direct equities, can be done. But I would spread my equities into mainly large caps. I again keep saying that we have to have this top pedigree large cap as our main core portfolio.